Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world, and sometimes that means figuring out if a company is really playing matchmaker or just playing games with its money. Out today, we're diving into a filing that looks like Match Group is issuing some new debt to clean up its existing debts. A common move, but one that always makes us curious about the details. Could this be a sign of confidence or just a financial shuffle? Let's find out. So what we have here is a Form 8K filing from Match Group. Think of an 8K as a way for companies to report important events happening right now that shareholders need to know about immediately. It's like a headline alert for big news. Match Group, as you probably know, is the company behind a bunch of popular dating apps like Tinder, Hinge, and Plenty of Fish. They're a huge player in the online dating world. Their stock ticker is MTCH, and you can find it on the Nasdaq exchange. It's pretty standard stuff to see their stock information here. Okay, now let's get to the juicy part of this particular report. On August 20th, 2025, a subsidiary of Match Group called Holdings Toffee took out a massive loan. We're talking about $700 million. And this isn't just any loan. These are called senior notes, which essentially means they're promises to pay back the money with interest. The interest rate is 6.25%, and they don't have to pay it all back until 2033. That's a long time. When companies borrow money like this, they don't get the full amount because there are fees and costs involved. In this case, after paying those costs, Holden got about $699. So what are they doing with all this borrowed money? Well, they're using it to pay off other debts. Specifically, they're paying back 0.875% exchangeable senior notes that were due in 2026. Now let's talk about how this new debt ranks compared to their other debts. These new 6.125% notes are considered senior unsecured obligations. That means if something were to go wrong and the company couldn't pay all its debts, these new notes would get paid back before debts that are ranked lower. They are also not secured by any specific assets, meaning there's no property tied directly to paying off this debt. However, there's a catch. These notes are structurally subordinated to any debt from subsidiaries that don't guarantee these new notes. This means that while the notes are senior to other unsecured debts, they are actually lower in priority than debts from those specific non-guarantor companies within Match Group. It's a bit like saying, I'll pay you first unless my other kids have debts I promised them first. Even more importantly, these new notes are effectively subordinated to any debt that is secured by assets. So if Holdings 2 or its subsidiaries owe money that's backed by specific property, that secured debt gets paid back first from those assets. This means if the company faces financial trouble, the holders of these new 6.125% notes could be in a weaker position compared to holders of secured debt. The agreement for these notes, called an indenture, comes with some rules designed to protect the lenders. These rules or covenants basically limit what Holdings 2 and its related companies can do. They can't just start putting liens on all their assets willy-nilly, and they can't sell off the entire company without some restrictions. These are pretty standard protections for lenders. There's also an interesting clause here. If the notes get a good rating from credit rating agencies like Moody's and Standard & Poor's, and the company isn't messing up on its payments, then some of these restrictive rules, specifically about needing future guarantors, loosen up. This shows that good credit can bring more flexibility. Now for the what-if scenarios. If the company breaks the rules of the agreement, what they call an event of default, and this situation continues, the people who manage the debt, called the trustee, or at least 25% of the people who bought these notes, can basically demand all the money back right away. That's a pretty strong power for the lenders. And if the default is related to bankruptcy or the company being unable to pay its bills, the debt is immediately due and payable. No questions asked. The lenders can demand their money back instantly. This highlights the severity of financial distress for the company. You might notice these notes weren't sold to just anyone. They were sold to qualified institutional buyers under a rule called 144A, which allows for private sales to big, sophisticated investors. They also sold some outside the US under Regulation S. This means these weren't publicly offered to everyday investors, means these weren't publicly offered to everyday investors, means these weren't publicly offered to everyday investors on a stock exchange. The actual full legal document for this debt agreement is filed as Exhibit 4.1. It's the complete rulebook for this $700 million loan. This filing explicitly states that this debt issuance is considered a direct financial obligation of the company. This is important because it means it's a real debt that's now officially on the company's books. This last section just lists all the supporting documents included with this report, like the actual indenture we just talked about and the form of the actual note they issued. Now let's put this all together with a bit of a Warren Buffett style analysis. Match Group is essentially trading in its older, cheaper debt for this new, more expensive debt. They're paying off 0 cheaper 25% interest notes. That's a significant jump in the cost of borrowing. Why would they do that? The filing says they're using the money to pay off the 2026 notes. Perhaps those older notes had some tricky terms or called for repayment soon. By issuing new debt, they are essentially refinancing. The higher interest rate suggests that either the market demands it because of current interest rates or Match Group's perceived risk has increased since they issued the older notes. The fact that they are issuing senior unsecured notes means they are not putting up specific assets as collateral. This can be good because it keeps their assets free, but it also means in a bankruptcy scenario, these note holders are further down the line for getting paid back when compared to secured lenders. What's the story here? Match Group is managing its debt, but at a higher cost. This could be a strategic move to restructure their finances, perhaps extend their debt maturity, and simplify their debt structure. However, the increased borrowing cost is a notable point. It's like choosing to take out a new mortgage at a higher rate to pay off an old, smaller one, maybe to get a bigger loan for something else, or to avoid a looming payment. With a 6.125% interest rate, which is quite high, this is expensive money. A key risk to watch is how these higher interest payments will affect their profitability going forward. If revenue growth softens, that extra interest expense could really eat into their earnings. On the other hand, if they are confident in their future cash flow from their various dating apps, they might see this as a necessary step to have more financial flexibility. Overall, Match Group is actively managing its debt, but the market seems to be a more expensive place to borrow now compared to when some of their older debt was issued. This move itself isn't necessarily a red flag, but the higher cost of capital is something investors should definitely keep an eye on. Alright, that's our deep dive into this Match Group filing. What's your take on this debt swap? Are they smartly refinancing or signaling tougher times ahead? Let me know in the comments below. If you found this breakdown helpful, be sure to give this video a like and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching and see you next time.